Thanks for taking the time today to discuss budget projections. My name's Doc Dwyer. With me today is Matt Walter and Colm Sharon. We will be talking about the two most popular methods of forecasting aviation budgets, cash flows and profit and loss, more commonly known as P&L. For our example, Colm and I will discuss cash flows, Matt will take the P&L. Both Matt and Colm are very well suited for the assignment. Colm holds two graduate degrees encompassing management, finance, and international business. Matt is one of our two CPAs at Guardian Jet and earned his master's degree in accounting. The two methods have different purposes, and throughout the video we're going to discuss which gets used where the confusion can come from in mixing up the two methods. Matt and Colm are going to walk us through a budget projection using both methods. We'll point out some clues to help you determine which method is being discussed if you walk into a conversation and you're not sure. And finally, why is this important to know as an aviation manager? First, let's talk about the cash flow. Simply put, a cash flow is the cash in and out of a checkbook over a period of time. In our 5-year example, we'll break out each year and then sum the entire period. Our 5-year, after-tax, Part 91 example will not generate revenues, so the cash in will be in the form of a tax savings during each year. Most cash flows are after tax. The cash out will be fairly straightforward.
On the profit and loss side, more commonly referred to as the P&L, we will discuss reporting standards as defined by the Generally Accepted Accounting Principles, GAAP, which are determined by the Financial Accounting Standards Board, FASB, a private, non-profit organization designated by the Securities and Exchange Commission, SEC. Now I know this is a lot of acronyms, but these are all clues that will later point to which method we are using, the P&L method or the cash flow method. The P&L is the partner to the balance sheet in the financial statements that are created periodically, monthly, quarterly, annually, for corporations or individuals. The simplest way to understand these two methods is to show an example. In our example, we'll show the expense under each method for a 5-year period. The parameters for both methods are the same. A purchase price for the aircraft of $10 million, flying 400 hours per year, variable cost of $3,000 per hour, and fixed cost of $600,000 per year. Now the main expense component where the two methods differ is in depreciation. For book depreciation, we'll show a commonly used and straightforward depreciation method, which is 20-year straight line depreciation with a 50% salvage value. Think of straight line depreciation as being the same each year. Using a 20-year life for the aircraft, a 50% residual value means that the plane will be worth $5 million after 20 years. Therefore, in order to calculate the annual depreciation expense, we would divide 50% of the value, $5 million, by 20 years, which equals $250,000 per year. Now for the cash flow method, in order to show after-tax cash flow, we'll be using a 5-year maker schedule, which is the tax depreciation method set forth by the IRS and requires depreciation of the $10 million asset as 20% in the first year, 32% in the second year, and so on and so forth. Now that we've discussed the parameters, let's walk through the example on how each method differs. On the P&L side, the annual variable cost at $3,000 an hour when flying 400 hours a year is $1.2 million a year. The annual fixed cost, we already said, would be $600,000 a year. Now the annual depreciation expense is $250,000 a year, which again is calculated by taking half of the asset's value, since we're using a 50% salvage value, and dividing it by the asset's life, in our case 20 years. Depreciation is favorable to companies because it allows the entity to recognize the capital cost or purchase price of an asset over the asset's life instead of in year one. Now summing those three costs, the total annual expense and thus impact to earnings in year one would be $2.05 million.
So now, on the cash flow side for year one, you first have to pay the capital cost, the $10 million purchase price. Those $10 millions are money out of your pocket day one, year one. And then you still have to pay for the variable cost and the fixed cost. Remember, that's the cash flow analysis, so it's an after-tax analysis. So now let's focus on the tax impact for year one. The depreciation deduction will be 20% of the purchase price, 20% of 10 millions, where you can add all the variable and fixed costs. So at the end of year one, you've got a 3.8 million total deductible expenses. So the tax benefit will be 35%, which is the tax rate, 35% of those 3.8 million, which is 1.33 million. So if you sum all those numbers for the cash flow analysis year one, you will have a cash out of 10.47 millions.
Now, we're not going to look at each of the 5 years individually, but it's just important to know that under the P&L method, years 1 through 5 are actually the exact same expenses.
On the other side, on the cash flow analysis, year 2 is completely different than year 1. You don't have to pay any more for the capital cost. You still have to pay for the variable and the fixed cost. The tax impact will be also different because in year 2, you've got a 32% depreciation rate where you can add the variable cost and the fixed cost. So in year 2, the total deductible expenses will be 5 million. So the tax benefit will be 35% of those 5 million, which is 175 million. So at the end of year 2, if you sum all those numbers, the cash out will only be $50,000.
So after 5 years, we simply sum all of the costs to show the impact to earnings over the 5-year period. Variable cost, $6 million. Fixed cost, $3 million. Depreciation expense, $1.25 million, for total expenses over the 5-year period of the P&L method of $10.25 million.
For the cash flow analysis over the 5 years, we've got the same variable and fixed cost, but we have also the purchase price of 10 millions. And over the 5 years in the cash flow analysis, the total deductible expenses will be 18.4 million. That gives you a tax benefit of 6.4 million. So again, over the 5 years for the cash flow analysis, we've got a cash out of 12.5 million. So you can see that between the cash flow analysis and the P&L analysis, there is a significant differences over the 5 years.
Now let's take a look at the terms and concepts that are clues to which method is being used, because oftentimes we're parachuted into a conversation and it can be difficult to determine. For the P&L method, anytime we hear on the books, balance sheet, income statement, statement of equity, earnings per share or earnings impact, which is affected by selling at, above, or below the current book value, annual depreciation number in my budget, GAAP, FASB, SEC, mark to market, which is writing the asset up or down to reflect the current fair market value, impaired asset, meaning the book value is greater than the fair market value.
If you hear after tax, makers, or out of pocket, cash flows are being discussed. Basis or tax basis, the amount an asset still has to be depreciated, and capital gain, the amount an asset was sold above its basis. Both of those are also clues that cash flows are being discussed. Now let's take a look at why each of these are important to you. The P&L method is important because public companies report earnings and have a duty to earn as much as possible for their shareholders. Selling at a loss negatively impacts those earnings and is not desirable. We need to stay aware of our book depreciation schedule to keep it in sync with the real value of the aircraft. That's mark to market. Typically, your annual budget will come from this, and this creates a little conflict. Budget reduction looks good or improves earnings, but can set you up for a book loss as you go deeper into the life of the asset. So you can see there's a little balancing act that goes into this. Now, let's take a look at what makes cash flows important to you. When you're discussing cash flow, you're talking about what's out of pocket. You're talking about CapEx or capital expenditures. Most CapEx models are cash flows with time value of money added in, NPV or net present value. When you compare cash versus finance versus lease, they'll always be compared with cash flows. During fleet planning, oftentimes both models will be used, but it's rare to see a plan that doesn't have cash flow life cycle costs as its foundation.
Thank you very much for taking your time to learn more about this topic.
Feel free to contact us if you would like to discuss this topic in greater detail.
We'd love the opportunity to prepare a projection built to your specific requirements.